I'm Ted Franks. I'm the fund manager here. This is Ben Kluftinger, who will introduce our guest.
Yes, all right. Thank you very much, Ted. So this is our second fire chat set to introduce one of our portfolio companies. And it's a very great pleasure for me to welcome Bill Siwek he's president at TPI Composites. Now, US-based TPI Composites is the world's largest independent wind blade manufacturer. And it hasn't quite been that for all the time. In fact, the company started in 1968, called Tillerson Pearson Incorporated. And I should have made a sort of quiz question out of that, what they did. They were doing high performance sail and powerboat manufacturing. Then in 1999, the current CEO, Stephen Lockhart, joined the company. He saw the light and refocused the company to produce wind blades. Bill, he joined in 2013 as the Chief Financial Officer and was a driving force in pushing growth further of TPI and the IPO, which came 3 years later. And in fact, just 1 month ago, Bill got promoted to president of TPI Composites, overseeing the global production, the supply chain, finance, and a whole other raft of things. So congratulations again, Bill.
Thank you.
We met Bill actually about 2 years ago in 2017 at a number of conferences. And we pretty much very quickly sort of saw the potential in that company. So we went away, did our research, and in fact, quite soon after, initiated a position in TPI, which then, if you look back at the performance, it was in line with the fund performance, which is a little bit unfair because it was actually a fantastic performer for a very long time. But it hit a few, in our view, short-term hurdles quite recently in spring, which we can and hopefully will touch on. And but we are very confident that they will overcome those, and the company will be bouncing back very soon. With that, over to you, Bill.
Well, thank you. Appreciate you having me, and nice to see all of you, and maybe I'll get to meet a few of you after, but appreciate the opportunity. So there's about 5 or 6 slides. I'm gonna limit it to probably 3. And that's just a subset of the deck that's on our website. So if you're interested, you can go to the website and see the full investor deck. There's a lot of detail, but I can cover it pretty much in 3 slides. So with that, I'll start. As Ben mentioned, we're the only independent manufacturer of wind blades with a global footprint, which is important when you think about the scale, the size of the blades. We provide wind blades to the top original equipment manufacturers, trying not to use acronyms. In the industry, so our customers are Vestas, Siemens Gamesa, GE, Nordex Acciona, and Enercon. We operate 10 wind blade factories around the globe today. We've got 1 under construction in India, so we have 2 in Turkey, we have 3 in China, we have 4 in Mexico, 1 in the US, and then 1 on the way in India. We also have tooling facilities where we actually build the molds that we build the blades in 1 in Mexico and 1 in China. We have an advanced engineering center in Kolding, Denmark. And then we have an R&D facility as well as transportation facility on the east coast of the US where we were founded back in Rhode Island, as well as in Newton, Iowa, which is about a mile down the road from our blade plant. We do bus bodies there, and we'll talk a little bit about the EV space as we get through the presentation. We've had strong historical financial performance, notwithstanding the little bit of a stumble here in the first quarter of this year. But from 2013, we had compound annual growth rate for revenue of 37%, 52% for our EBITDA. And then our adjusted EBITDA margin has grown from 7% to 13.9%, and that's as adjusted for startup and transition costs. So why TPI? I've got a different order in here. we talk in our investor deck. We talk about it as the investment thesis for TPI. I switched up a little bit here, but we're capitalizing on wind market growth, the trend of blade outsourcing, as well as the improving economics of wind. So the overall wind market has been growing. It's been growing fairly strong. If you look at it from a total onshore market, the 10-year growth rate is anticipated to be about 8% in total. If you look at the emerging markets, which is where we focus with our customers, that's estimated to grow in the 24 to 25% growth or average growth rate over that 10-year period. If you think about offshore, it's been a relatively small part of the overall market for a number of years, but it's starting to explode. With the cost continuing to come down, it's now migrating from just kind of a North Sea, Northern Europe, UK phenomenon. Now there's a ton of it being planned for the east coast of the US. Floating platforms for offshore turbines are being developed, which would work very nicely on the west coast. And then there's a ton going in Asia as well as in India as well. So we think the long-term market is very strong, and we're going to help expand that market through outsourcing and enable our customers to expand into the emerging markets more efficiently. As I mentioned, we are the only independent blade manufacturer with a global footprint. We're building blades today that are anywhere from 60 to 73 meters long, single blade. They weigh 18 to 20 tons. So these are huge, huge structures. So being in regional locations where we can cost effectively hit wind farms. So for our customer, the most important thing is total delivered cost to the wind farm. So although we can build blades in India or in China or India and ship them all over the world, if there's a wind farm in Turkey, we'd rather have a facility in Turkey to minimize the transportation cost. So having a global footprint allows us to help our customers more cost effectively hit their markets. It gives them supply chain flexibility as well. Advanced composite technology and production expertise provide a barrier to entry. As Ben mentioned, we started as a boat builder in Providence, Rhode Island in 1968. A wind blade is very much like a boat hull, if you think about it. So we've got years of experience in advanced materials, non-destructive testing techniques, the actual tooling to build the wind blades. And one of the most important things is the design for manufacturability. That's where our engineering teams intersect with our customers' engineering teams. They provide the airfoil shape, the shape of the blade, and the internal structure design, and then they throw it over the wall to us and say, now build this. Well, we go back to them with our engineering team and we look at ways where we can tweak the design, adjust the materials to make it more efficiently manufacturable. So it's all about driving cost out of the blade, and that's kind of where we intersect with our customers. That results in a very deep collaborative relationship with our customers. We are an extension of them. The wind blade is a very strategic part of the turbine. They differentiate turbine performance in many cases on the design of the blade. So each of the blades we make is different for each of our customers. So it's a very collaborative and deep relationship. We sign long-term supply agreements with our customers, generally 5 years. They're minimum take-or-pay agreements. Early years, the minimum is our max capacity, and then it typically stair-steps down to 75% in year 3 and then maybe 50% by year 5. We generally don't ever operate at the min, and that's because usually 2 years, 3 years into it, our customer's asking us to transition the blade to a longer blade. And we'll talk a little bit about the blade lengths in a bit. And as we transition that, we usually take the chance to extend the contract, and then those minimums move to the right. So generally, unless we're going through a transition or a startup, we're operating closer to the max capacity of our plants. I'm not going to hit this slide, so I will talk about that here. So under the long-term contracts, today we do have 52 manufacturing lines under contract. Those contracts run through, the longest one through 2023. It represents $6.3 billion of potential revenue under those contracts at the max. The min is $3.6 billion. So we've got the long-term contracts gives us great revenue visibility into the future. It's also great for our suppliers, which enables us to negotiate better terms. We can be a base load for our supplier because they can count, number one, they've seen what our growth has been, but they also know that we've got these long-term contracts that are guaranteeing volumes. So it works. It's great for us with our customer, but also we use it as leverage with our suppliers. Our model is capital light. We think it's capital light. We don't own the real estate. We own one plant in China, but other than that, they're leased facilities. But what we invest in is the unique capital inside the plant. And so it's anywhere from $5 to $6 million per line that we'll invest in. It's in advanced HVAC for air circulation, humidity control, temperature control, big ovens. I call them easy bake ovens, if you remember those. They're these huge ovens that are 70 meters long where we cure the blades. And then our customer invests alongside us in the tooling or the molds. So generally they ask us to build those molds for them, and we like to do that. It's a profitable part of our business. But they're investing in the mold. So it sits in our factory, but it's their CapEx. So it's relatively CapEx light for them. It's relatively CapEx light for us. And as a result, we have very compelling returns on invested capital. And then finally, the management team, we're really happy with the team we've been able to assemble and retain. We've made some changes over the last month or so that we think we've strengthened the team to take us to the next level. We should be at about $1.5 billion in revenue this year. That's what we've guided to, $1.45 billion to $1.5 billion. We look to go to $1.7 billion to $1.9 billion next year. And if you think about 52 lines under contract, we'll add, we've got a prioritized pipeline of 19 additional lines that we plan to close on between now and the end of 2020. So let's just say we're at 65 lines, operating at 80% utilization conservatively. So we're in the 50 plus number of lines. Average revenue per year per line is between 37 and 40 million per year. So if you do the math pretty quick, you're at a $2 billion company. So we believe, we've got $2 billion of revenue top line of sight over the next couple of years. All right, so now I'm going to flip a little bit here. This is just more detail that you can look at when you have a chance. So obviously, I'd be remiss if we didn't hit this slide. But this is something that we identified a couple of years ago. We've got 3 real high-level strategic goals for the company, and one of those is to be ESG gold standard. So we take it very seriously. We started our journey last year. We engaged Deloitte Consulting to help us through the materiality assessment, identifying the right metrics. We talked to stakeholders, both internal and external, and we've identified, the key materiality, or we developed the materiality metrics and then the key metrics that we are going to measure going forward. We've set up the data collection processes so that we get them consistent around the globe, so the data that we're collecting is in fact accurate and relevant. And then we plan on starting to report publicly on that in 2020 with the GRI Core report as a start. So our CEO likes to say we can do good and we can do well, right? We can do both. And doing good, it's the right thing to do, but if we really operationalize and embrace this initiative, it's going to help us drive cost, improve safety, drive profitability, and drive growth. So we're doing the right thing, and we're going to do it well. So with that,
Thank you, Bill.
I'll open it up for the grilling.
It won't be a grilling. So thank you very much, Bill. That's a great intro. And just to highlight, a couple of things. I hope you got the sense of it. I mean, what we like from an investment point of view is this incredible visibility that TPI has over its long-term revenues. And this story is very important to us as well. Now, clearly, we've got Smurfit here, and these guys are a long way down the track. They can hit you over the head with 100 pages of report. But if we can help our companies and show them that as shareholders we want them to go on this journey, and I hope that our communication with TPI was part of that, then this is us adding a little bit of value there as well. So, enough of a plug for WHEB. First question is just a very general one on the wind market. You're talking about the 8% in developed markets, 20% in emerging markets. What are the kind of upside and downside risks for how that might not be delivered? And then the other sort of very big picture, you guys are all about reducing the cost of the wind turbine blades. We know the solar guys are all about bringing their cost curve down. Is there a point at which wind has a problem with solar?
So I'll take the first one first. We actually think that the estimates for the market growth over time are relatively conservative. If we look at BNEF a lot, Bloomberg New Energy, and Wood Mackenzie, which used to be MAKE, they will tell you that in most cases they look at the out years and they are very conservative. Each time they come out with a new forecast, those out years tend to bump. So yeah, I think we feel very comfortable with those growth rates. I didn't mention specifically the offshore, but that's estimated to grow at 20+% rate as well, off a much smaller base, but still an attractive market. So what are the potential roadblocks there? In the U.S., we've got the phase down of the production tax credit, which our industry lobbied for, because we're at a point from an economic standpoint where it makes sense to do that.
Lobbied for the removal of the...
Yes, we lobbied for the removal. Now there's talk, and there's bipartisan bills in Congress this week about a technology neutral ITC for the long term. Solar will have an advantage long term. They've got a permanent investment tax credit of 10% once it phases down. So there's some of that noise. We'll talk a little bit about tariffs, I assume, at some point in the session. That could have an impact on individual markets potentially and the demand, because it will, right, regardless of what the U.S. president says, it does raise the cost of goods coming in, and the other company doesn't pay for it, or the other country doesn't pay for it. So that could have an impact as well. And then there's other forms, right? But we think we look long term. We think about wind, solar, storage, and transmission. Storage is going to enable much deeper penetration. It eliminates some of the intermittency of both solar and wind. So, but we feel very good about that. And your second question?
Well, you've kind of hit it really. Okay. The solar trajectory.
The solar. Yeah, we think there's room for both. I mean, there are parts of the U.S., for instance, where solar wins usually in California, for instance, where I'm from in Arizona. It's not very windy, but it's really sunny and it's really hot, so it works. My roof is covered with it. I will admit that. It's great. But there are places where wind works better. Today in Iowa, where we have a factory, it's 40% wind with zero storage, right? So I think there's room for both. Texas, it's both. Yeah. So I think there's room for both, but yeah, we're gonna keep fighting on the cost curve, because the solar cost curve is steeper than our curve right now.
Okay, great.
May I come back to this sort of value proposition that you're offering? When you look at your customers, I mean, they're pretty mighty in their space. They've been doing this for decades. They kind of know this stuff themselves pretty well. What is the value proposition really that you can bring to them that they can't do themselves?
Yeah, so it's a combination of things. Number one, it's access to emerging markets quicker. So it's a capital deployment issue for them. So would they rather spend money on new product introductions and improving the efficiency of the turbine itself, and let somebody else invest the capital in a blade plant in an emerging market? If they only need 2 lines in an emerging market, it's not a very efficient factory. If we can take 2 lines of theirs and 2 lines of somebody else and 2 lines of somebody else and spread that overhead, it becomes a cost issue for them too. So it's access to our technical talent. It's an allocation of capital issue for them, quicker to the emerging markets. So it's a combination of those things. And then if sorry to interrupt, but if you were to ask most of our customers and they answered you honestly, they would tell you we build blades better than their internal shops do. That's part of it. We're not only, it makes sense, right? Because if we can charge them a margin, 14 to 16%, and they're still buying from us, there's got to be some cost differential. So we build very practical plants, not Taj Mahals, very practical plants. And that's all we do is build blades today, right? That is what we do. We'll build 7,000, 7,500 of them this year. So it's a lot of blades, and that's what we do well. And we build them generally faster, generally cheaper, and we build them with very high quality. So,
sort of a follow-on there. Now, one of the snags that there were short-term was Senvion, one of the wind turbine manufacturers, going actually bankrupt. And you listed 6 customers there. The expectation is that this market is going to consolidate. It is already quite consolidated, but it's going to consolidate even further. And we'll have, at some point, 4 or 5 really big manufacturers in this space. Do you think this is going to change sort of anything for you in that respect? Or do you think it doesn't really matter too much whether you deal with 10 or just 5?
I think long term it's actually good for the industry. I think it provides much more stable pricing. You get rid of some of the irrational pricing that we're seeing today. Part of the challenge for Senvion, I believe. And if you believe in what the projections are for the overall wind market, that capacity still needs to be built. So somebody's still got to build it. Now, depending on who gets that volume, but if we've got the top 5 today, and we keep the top 5 today, we're going to get our fair share of that. So I think it helps the overall pricing and stability of the market from our customers' standpoint, which then takes a little bit of the margin pressure off of us as well as time goes on.
Right. Staying somewhat on the technical side, first a sort of relatively more educational question. In terms of the blade length, what we observe is that those wind blades become longer and longer over the years. First of all, maybe you can give us a little bit of a trajectory there, and what is the reason why do they become longer?
Yeah.
And then as a sort of follow-on straight away, which is for me the more interesting part there, is there a theoretical limit? Like you have solar, there's a theoretical limit how much you can get out of a solar cell. Is there a theoretical limit where you can say, well, we are at 80 meters, I think, sort of the maximum length. 120, that is it? Or can this just go on?
Yeah. So on the evolution of the blade length, if you think about wind, the levelized cost of wind energy has come down by close to 70% over the last 7-8 years. And that's been primarily driven by taller towers and longer blades. So pi r squared is really important in wind. It's the size of the sweep of the rotor, and the bigger that rotor gets, the more wind you capture at lighter winds. That converts it into energy much more efficiently. So that's what's been driving the levelized cost of wind energy down. When I started with TPI, our largest blade was 48.7 meters. Today we're building 73-meter blades. Our smallest blade is 59 meters. So that's just in 5 years. They've gone from that. Offshore is much bigger. So offshore is generally 80 to LM, who is owned by one of our competitors, but owned by GE, one of our customers, is building a 107-meter offshore blade right now. It's actually built, and they're putting it on their Haladad platform that's going to be tested here in Europe for offshore. So I'm not an engineer or a physicist, so I can't tell you how long they can go before they just, that tip speed at 250 miles an hour, I don't know, what force that can withstand. But the bigger limitation, I don't think, is how big the blade is, it's how do you transport the blade, right? And so for onshore today, 70, they said we'd never transport a blade beyond 50 meters. Well, we're doing them up to 80 meters today. I think the next phase is split blades or modular blades, where you have kind of a root section, and then you build the tip, and you transport it in 2 pieces, and then you join it at the wind farm. The technology exists today. Some of they're flying blades today in trials. Commercially, the cost is still not quite there yet because all the logistics guys are still figuring out how to move the big blades. Onshore, it's different. You really don't ever want an onshore blade to touch a truck. So today we move blades by truck, rail, and ship. Offshore, it's mainly you roll it out of the factory, put it on a barge, and you take it out to the wind side. They're just to digress a little bit. I saw a thing the other day. They're actually talking about potentially moving blades by big blimps.
Like what?
Blimps, like dirigibles,
right.
the Hindenburg type thing,
Oh,
the
right.
Goodyear blimp. An airship. I'm sorry. There we go. An airship.
I was actually just about to ask you whether helicopters is an option or it's just too expensive.
They do, but it is expensive.
Right. Okay.
Yeah. So today it's trucks, trains, boats, and big cranes.
Okay.
Yeah.
Moving on to a smaller business for you guys at the moment, but one which we're quite excited about. Obviously, your great skill with composites, producing frames, and you have now a business around electric vehicles, right? Particularly starting with transit buses, electric buses. I think you have a contract with Proterra.
Correct.
So can you tell us a little bit, why you're right for this space and how big it could get?
Yeah, it's interesting with the electrification of the vehicle fleet. We see that we've got the advanced composite technology skills, so we think it's right in our wheelhouse. Building the bus, it's an all-composite bus body and chassis. There's no metal in the bus. The only metal are where they connect the electric motors, if you will, on each wheel. But it's an all-composite bus. It takes 4,000 pounds out of the weight of the bus. So for ground transportation, weight is like gold, right? So if you can take 4,000 pounds of weight out of the structure of the bus itself, it extends the range of existing batteries. which is the most expensive part of the vehicle, or you can reduce the number of batteries. So it's really about weight savings. And the durability, we've demonstrated the durability by building blades that last 20 to 25 years, boats that last even longer. And so it's a natural place for us. We're also, we have a development agreement, joint development agreement with Navistar for Class 8 cabs, the big semi-trucks, and frame rails for the trailers, all out of composite. It's a 40 to 45% weight savings over a steel cab, 25% weight savings over a aluminum cab. So even if you don't go all electric, you do a hybrid, a CNG, compressed natural gas, or even an internal combustion engine, taking weight out adds to the fuel efficiency for those as well. We also announced a development program to deliver some prototype, purpose-built commercial delivery vehicles in early 2020. So think about, and you guys will think about this, right? You think about FedEx and UPS and Amazon and DHL and the U.S. Postal Service, electrifying that vehicle fleet. We see that as a great market for us, and it's for the same reason. It's for the lightweighting of the vehicle.
Yeah, yeah. I worry about it. I cycle home past the UPS base in Kentish Town. I'm regularly nearly run over by the brown buses. If they were silent, I would definitely be run over.
But it's good that that'd be a problem.
It's good that
then it would be
we
a
can
problem.
cross that bridge. Now, I'm conscious that we've not done a brilliant job time-wise. Ben, why don't you give one last one from the home team, and then we'll open up the floor and see. But thank you, it's been great so far. So go, Ben.
Yep. Well, maybe one on the ESG side. We had been in touch with you a while back on the sort of issues of dermatitis. Now, producing those blades is obviously a highly skilled job, but it involves quite a number of resins, chemicals,
yes.
And it's a manual job partially. Maybe you could update us there. What happened to this? How you've changed your policies, and is it still an issue?
So dermatitis is basically a skin allergy. So some people are sensitive to the resins or some of the other chemicals we use in the process. The interesting part about this is there are no standard protocol for personal protection equipment from the manufacturers of the resins we use or the chemicals we use and how we use them in the processes we do. So we've worked with industrial hygienists, workplace safety people, as well as the chemical manufacturers, to identify what the best type of protection equipment is. And it's basically, it's like a clean room suit, if you will, but it's not permeable by the resin. So part of the challenge is you get the right protective gear. You never really want anybody to be handling resin with bare hands or with bare arms or bare legs or what have you, right? So you got to get them to wear the stuff to begin with, and then you have to make sure they put it on correctly. So part of it was making sure we had the right protection equipment. Part of it was making sure they actually used it when they were supposed to, so it's more diligence on the floor. And if you think about it, between 2008, which is when we built our first blades in Iowa, to 2015, that's where the majority of our dermatitis issues arose. That's when they arose. In 2016, we instituted a resin allergy test pre-employment. So just like if you're allergic to peanuts, you probably shouldn't work in a peanut factory. If you're allergic to resin, you probably shouldn't work in our factory, right? So now we do that pre-employment. So since we've instituted that on a global basis, and we have almost 12,000 employees, we will work about 40 million hours next year. Our dermatitis exposure has been 10 or less each year since we instituted that. So you're still going to have it, but we've done our best to try to eliminate it altogether, and we're still working on it. We're still making progress.
Actually, slightly change tack. We'll just squeeze one more web question because I do want to know the answer to this one. Actually, the one about the life cycle of the blades. Of course, it's an epoxy resin, isn't it? So what is the current end of life sort of disposal strategy?
That is a challenge that as an industry we need to figure out. If you think about today, there are some companies out there that are taking them down, cutting them and grinding them. They grind them into pellets, and then you can turn those pellets into like deck boards, patio furniture, that type of thing. But that's not the best solution. The best solution is changing the materials we use to go into the blade. So thermoplastics, for instance. If we could do that, then at the end of life, you could basically melt it back down and separate the parts. It's been a cost issue around that to date, but that's directionally, I think, where the industry's headed.
Great. Okay, so at this point, I'll look out to the floor. Questions for Bill? Wind, anything wind related?
I need a microphone. Can you hear me?
Gotcha.
Yeah, go on.
Michael Johnston, Thetis Asset Management. Just answering the question, some years ago in London there was a company called Clipper Wind Power that I think made blades and made the whole turbine. I think during the recession it was bought out by UTX and I think owned by an equity company. I see they're still based in Iowa. Are they competitors in any way? Are they still going?
Yeah.
Are they a customer of yours?
They were an early customer. We built a prototype blade for them long before my time. It was probably in the 2000 time frame. They still have turbines that are up and spinning today in the U.S. I know for sure, but they're not actively in the business anymore, as far as I'm aware.
That's a Clipper, by the way. It was a banner stock, wasn't it? It was the best performing UK equity of them all in 06 or something. It went nuts. Yeah. So come.
Perhaps on the ESG roadmap, from what you described in terms of manufacturing these blades, it's very energy intensive. And I know you don't own your own manufacturing sites. You lease most of them bar one. How do you manage that intense energy source? Where does it come from? And is there, I don't know, maybe use of the parts of the blades that you manufacture?
We've talked about that at times. The turbines are pretty expensive, but it's worth it. Now, so in Iowa, we use a lot of renewable energy just because that's what we get from, that's what we request from the power provider, which is Mid-American, Berkshire Hathaway company. In Turkey, we use a combination of solar and wind, based on, that's in the free trade zone site we're in, because the free trade zone provides that for us. That's part of our journey, is to go eventually make the 100% renewable pledge, and we're working on where we're going to source all that from.
Over here.
Hi, Maggie Liu from Bridges. I wanted to build on your question on the end-of-life angle. Is there a way to, how does maintenance come into it? I mean, is there an opportunity to extend the life of a blade through better maintenance? Is there potentially an opportunity for you as a company to, I don't know, perhaps extend into that as a service?
Yeah, no, the blades are engineered to last between 20 and 30 years. If you think of the age of the wind fleet in the U.S., it's about 10 years. The age of the wind fleet in Europe is a little bit older. So it is a long life, and they last longer if you do proper maintenance on them. And we do some of that. We do have a service business. Most of our customers want to own that service business, because they'll basically give away the turbine for a 20-year service agreement, because that's where they make the big margin. But yeah, they subcontract to us, and we do repairs and maintenance on the blades, pre-warranty, post-warranty. But that is an option to extend that. The challenge is that blades have gotten bigger so quickly, and the turbines are much more efficient. So you could probably replace, a wind farm in Northern Europe with a third of the turbines today if you put in brand new turbines. So that's part of the issue at the end of life, is the end of life has been shortened because of the efficiency of the overall turbine. But the maintenance piece is a good point, and that is something that's done regularly.
If you consider whole of life cycle kind of analysis of wind farms, I mean, firstly, quickly on the point, we also invest in one of Bill's customers, which is Gamesa, and yes, we absolutely want them to do the service piece, because from an equity point of view, we want that service revenue. It helps their margin enormously. But if you think about the whole life cycle piece, the interesting thing, of course, is the first sites which had wind turbines put on them were the best wind sites, right? So you have now this fleet of European wind sites which are absolutely cracking, and they've got these little 20-meter machines on them just like spinning away.
We call them toothpicks.
Toothpicks, I mean, literally. So there is this repowering story that actually, obviously you've got to solve the end of life, and those early machines weren't really designed to be recycled in a sensible way, but frankly, from a CO2 point of view, just get rid of the toothpick, stick one of these gargantuan pieces on instead, and your CO2 story is just way better. Yeah. Way better. But that doesn't mean you can ignore the end of life story, because you've got to think about the whole thing.
Great. Good point.
Yeah, go on. One more.
This might be a bit of a left field question, but I've been wondering about the the way in which we try to help people transition their careers in the labour force, and obviously wind promising so many new jobs in the future. Is that a consideration for you when you look at the experts, the engineers, even people doing maintenance? I know that people who work on oil rigs have the same skill set that work on maintenance for wind turbines offshore. Is that a consideration for you, offering people ways to transition into this career space?
Absolutely. Our biggest constraint today is technical talent. So, and we have to grow most of it because there's not a lot of people out there. So that is, you know, transitioning. We can teach the engineers the composite side of it fairly easily over time. But yeah, it's a great point. Yeah, we're looking for any technical talent we can find. In the U.S., wind technicians is the first or second fastest growing job, and it's a well-paying job. So it is a good transition for someone.
I've got a red flashing light, and I can't even see Libby. Is she? Are we at the end? Oh, there she is. We're at the end. Okay. I'm sorry. Well, Bill might hopefully stick around a little while.
I'll stick around. Yeah.
Thank you very much, Bill. We're now going to go to a coffee break.
Thank you.
Thank you very much.
Thank you.